As year end comes closer, a common question we receive from clients is, well, what can I do to maximize my deductions for charitable contributions? So today we're going to be discussing charitable donations and the new tax law. My name is Tony Cameron with TLDR Accounting, and today we're going to discuss charitable planning as it relates to year end. So what do I actually mean by that? When you give money to a qualified charity, so a 501c3, what happens is you then get an acknowledgement letter which says you gave X amount of dollars, say $500, you didn't receive anything in return, and it's considered a charitable deduction. Now, before the tax law changed, to itemize it was super easy to itemize. There was a very low threshold. Most of the time you received a benefit from making charitable contributions to an organization. And I know you've heard me say charitable contributions, charitable donations, donations to charity. They all mean the same thing. It's giving money to a qualified non-for-profit organization. Now, there were big changes with the Tax Cuts and Job Act of 2017. It increased the standard deduction, which then means to itemize, you need to have more expenses or deductions to be able to itemize. A decent amount of an increase here. So it doubled. You probably noticed this on your prior year tax return. And the problem is a lot of folks who say they give $1,000, they give $2,000, they were expecting to get a deduction for those, but they no longer could itemize because the standard deduction doubled. Now, this isn't the case if, say, you're in an area where real estate is still like through the roof, and so your mortgage interest is gigantic. Your real estate taxes, you're hitting the cap there at $10,000, and you also have charitable contributions. Unfortunately, it's hard to talk to that situation since I don't have numbers in front of me, and it really is going to vary per person. But there still are some things that you can do to, decide if it's super important that you get that tax deduction for charitable contributions. An easy way is to bunch them. So it's December, you know how much you want to give to an organization. Will it make sense to donate all of this in December for the 2019 tax year, or wait until January, make the donation in January, so then it'll be the 2020 tax year, and then you have more time, A, to donate more money, and B, to run the numbers on your itemized deductions. Now, it really will depend on the numbers we're talking about. If you're thinking of making a $10,000 donation, a $20,000 donation, at that point, you more than likely are going to get a deduction for it. If you're looking at smaller deductions or smaller donations such as $500, $1,000, it really is going to depend on what else you have going on. And in those cases, I would highly recommend that you either get a professional involved or you run the numbers on what your mortgage interest is, your real estate taxes, and see how much you actually need to donate to make it worthwhile. Now, bunching is a fabulous strategy. It's pretty easy to implement. You just really got to think about, should this be in January, should this be in December? Now, there's a step further. So you can still bunch, but there's this thing called a donor advised fund. And a donor advised fund is basically an account. You make your charitable donations to it, and then as you dictate, it gets sent to the charities. So a good way to look at this is you get the deduction when you put the money in it, but you can then spread it out to the charity, say on a monthly basis, on a yearly basis, how often you want to send that money to a charity. Now, you can't take money back out of a donor advised fund. It is out of your control at that point because you get the tax deduction at that point. The other thing is there's usually fees involved. A lot of times it's less than 1%, but you want to double check with other donor advised funds that you're talking to open an account with them. The other one is no, you can't take it back, okay? Once you make the contribution to the donor advised fund, you made the contribution. If you're interested in that, I know there's some great local ones in the Seattle area, and they do fantastic work. You do want to be looking at larger amounts if you're looking at opening a donor advised fund. So it wouldn't be something I'd recommend if you're not making larger donations, so over $5,000, $10,000, $15,000 a year. Otherwise, bunching is a great option. You know you're gonna give a monthly contribution to the Girl Scouts. Will it instead make sense to do all of it in December, all of it in January, or what you have going on? The big thing to remember is you do need to think about it this year, just because of the tax law changes. You don't want tax time to come around and be like, oh, I thought I was going to get a deduction for this, and you aren't. Now, if you don't care about the tax deduction for it, just make your charitable contributions as normal. You can just move forward with that. All right. If you found this helpful, feel free to subscribe to our YouTube channel or join our mailing list. We send out additional resources, videos, and articles via our mailing list that just go out to our subscribers.